Welcome to the first of many Mountain West financial trainings that will involve the regulations required by the Financial Crimes Enforcement Network, or what we're going to be commonly referring to as FinCEN. Following this training, there will be a link that will take you to a test on what you will hopefully learn here. There might be some individuals out there from areas of the banking industry or other depository institutions that have seen or dealt with this or similar regulations. FinCEN itself is not new. It's just broadened to include a majority of financial transactions, and that includes us. So let's get started. Established in 1990, FinCEN is the Financial Crimes Enforcement Network. This is a network of databases and financial records maintained by the U.S. federal government and is dedicated to safeguarding the financial systems from abuse. In 1994, FinCEN extended its responsibilities to include the Bank Security Act, or also known as the BSA, the country's most comprehensive anti-money laundering legislation. Under the regulations of the BSA, FinCEN requires financial institutions to record and report suspicious activity that might indicate possible money laundering or fraud, at the same time becoming the repository for suspicious activity reports, or what we are going to be referring to as SARS a lot. Effective August 13th of 2012, the BSA defined financial institutions to include any business entity that makes loans and finances purchases on behalf of consumers and businesses, loans and finance companies that extend personal loans, loans secured by real estate mortgages and deeds of trust, including home equity loans, and non-bank residential mortgage lenders and originators, or RMLOs. What they found is that residential mortgage lenders and originators, who are generally known as mortgage companies and mortgage brokers in the residential mortgage business sector, have been found to be a significant subset of the loan or finance company category in terms of the overall number of businesses and total volume. The Department of Treasury Financial Crimes Enforcement Network has published the final rules for the anti-money laundering, or AML program, and suspicious activity report filing requirements for RMLOs. That's going to make this the responsibility of each individual entity out there and not just the lenders. This is going to require, at a minimum, for financial institutions to maintain an AML program that will cover the development of internal policies and procedures and controls, the requirements to designate a compliance officer and optionally a BSA officer, have an ongoing employee training program set into place, and have an independent audit function to test these programs. What's going to be really helpful to keep in mind here is that the AML program requirements will match the size, location, and activities of the financial institutions. However, these requirements will still require all financial institutions to file those suspicious activity reports. FinCEN intends for this rule to include any business that accepts a completed mortgage loan application, even if the business does not in any manner engage in negotiating the terms of the loan, offer or negotiate specific loan terms on behalf of either a lender or a borrower, regardless of whether they accept the mortgage loan application. This is also intended to cover residential mortgage loan originators, regardless of whether they receive compensation or gain for acting in that capacity, and to cover initial purchase money loans and traditional finance transactions facilitated by RMLOs. With this new regulation, for the first time, the U.S. government, through FinCEN, is going to be imposing on RMLOs both a mandatory and a voluntary program for filing SARs through their e-systems established by FinCEN. The mandatory date for compliance with this regulation is August 13th of 2012. FinCEN expects all the filings to be done electronically through the BSA e-filing system, and it does offer tours and instructions for individual organizations to use their systems at the link offered here. Generally, this would be completed by a designated BSA officer or compliance staff when the BSA officer deems it necessary. The BSA review board, members of management, or a combination of all of those listed here. It's important to stress here that even if there's no BSA officer for a company or no actual compliance department per se, that these are still going to need to be filed when they are deemed necessary by members of management. Once an incident is identified, the filing of the SAR is required no later than 30 days after the date of the initial discovery if the facts that might establish the basis for filing are there. No later than 60 calendar days if there is no suspect identified on the date of the initial discovery that requires the filing. The necessity of filing these SARS reports can be either voluntary or mandatory. A voluntary report may be filed when there is any kind of suspicious activity that is believed to be relevant to the possible violation of any kind of regulation or law. This voluntary filing has no minimal amount. Mandatory filing, on the other hand, is when a SAR must be filed when a transaction involves or sums up to funds or assets of at least $5,000 and any one of the conditions that are listed here. When a suspicious activity is directed or attempted at or through an RMLO, when there is any indication that funds are derived from illegal activity, when a transaction is intended to hide or disguise funds or assets derived from illegal activity, if the transaction is designed to evade reporting requirements to the BSA, if it's transacted with no lawful purpose, if the transaction is not one in which the customer would normally engage, if there is no reasonable explanation for the transaction after examining the available facts, including the background and possible purposes for the transaction, if any part of the transaction would involve the use of the company's products or resources to facilitate criminal activity. Here are some examples of when filing a report could be necessary. High cash deposits, a person making deposit with little income and assets who deposits high cash values, unless that is he or she has a very good explanation. Irregularities in loan documentation, this goes far beyond typos and two more obvious signs of information being omitted or altered. It is not limited to hiding liabilities, properties, or identity. Employee theft, money transferred or being transferred to a country that would raise questionable red flags, false identification documentation, falsified requests or verifications of deposits or assets, attempted bribes, and check or wire fraud. By itself, this is a very important reminder. Federal law requires that a financial institution and its directors, officers, employees, and agents who voluntarily or by means of suspicious activity report suspected or known criminal violations or suspicious activity may not notify any person involved in the transaction that the transaction has been reported. This is not only covering reporting borrowers, agents, or anyone outside the company. This will include the very person who brings the alleged suspicious activity to the attention of management or the BSA officer. At the point the claim or request is made, the information should be recorded by the proper channels, but the participation of any of those not directly involved with the reporting decision or the reporting itself should come to an end. What is mortgage fraud? The FBI defines mortgage fraud as any material misstatement, misrepresentation, or omission relied upon by the underwriter or lender to fund, purchase, or insure a loan. In today's financial world, this professed creative financing is as outdated as big hair and bell bottoms. As many of us have seen through the past 6 or 7 years, if at any time a lender discovers any part of the loan application is false or misleading, it can demand full payment on the loan. The mortgage professionals who are careless enough to actually use these methods will find the FBI knocking on their door, facing heavy fines and even jail time. Some of the more common examples of mortgage loan fraud can be explained as undisclosed kickbacks, where a deal is struck between a buyer and a seller and knowingly not included in the mortgage loan documents. When a silent second mortgage is placed on an asset that is also not disclosed to the lender of the original loan. Falsification of income. This has been seen the last few years on loan transactions where the borrower's income is difficult to verify and the borrower relies on that fact in order to inflate their earnings and numbers on a stated income loan. Non-owner occupant claiming occupancy. A buyer saying they intend to occupy a property when they never really intended to occupy it at all. Down payment gifts you will repay. Both the giver and the recipient commit loan fraud if the gift is to be repaid. Gifts cannot be repaid. Inflated purchase price is the practice that involves artificially inflating purchase prices in a way that deceives consumers and or lenders to create phantom equity in a property. It's often substituted as a source of down payment or for a legitimate down payment assistance program. Falsifying documents. Dishonest borrowers who do not have an earnest money deposit might state in the contract that the deposit was paid outside of escrow. And here we have more common mortgage loan fraud examples, like document forgery, the process of making, adapting, or intimidating statistics or documents with the intent to deceive or misrepresent the facts. Signature forgery, the act of falsely replicating the signature of another person. Straw buyers, where a person or an entity makes a purchase for another person. A straw buyer is often used when the real buyer can't qualify for the loan or complete the transaction themselves. Overstepped authority, when an originator or lender oversteps their written or verbal authority, generally means that they have run credit, submitted, or obtained information without the proper consent from the borrower or borrowers. Identity fraud. This occurs when somebody uses a stolen identity to open a bank account, mortgages, credit cards, or even fill out applications for a job. This will usually involve some sort of stolen counterfeit document, such as passports and driver's license. This is very similar to identity theft. The difference here is that with identity theft, a thief is usually attempting to assume the entire victim or the victim's entire identity instead of just trying to assume their credit. What is real estate fraud? Real estate fraud has also been commonly known as or linked to mortgage fraud. However, on a broader aspect, it touches some areas that we would not lump into the terms of definition of mortgage loan fraud. Real estate fraud is a false representation coupled with the intent to deceive made in conjunction with any real estate transaction. This can encompass many examples we have shown, such as identity theft, straw buyers, but it can reach far outside the usual purchase money loan and refinances. Here's some examples of real estate fraud. Loan modification fraud. This includes lenders making false promises of reducing loan balances, payments, or saving the borrower's home and or credit in exchange for money. There's foreclosure exploitation, where a party will collect fees in exchange for deeding a property to a third party who falsely promises to delay or prevent foreclosure on a property. There's private equity fraud. This is the practice of obtaining investors or an investor's money without properly securing their investments in real estate. This is known as the theft of the owner's equity. Real estate mortgage fraud falling into the category of elder abuse, which we're going to be hearing a lot more of coming up with the CFPB. Typically, this type of fraud is committed by homeowners, relatives, caretakers, or financial advisors. This is a product that has been made available to people 62 years of age or older, allowing homeowners to convert their equity into cash. The bank pays them in one lump sum, a line of credit, or monthly installments. Those close to the borrower usually walk away with a large sum of money, with the borrower receiving little to no benefit from this transaction. Structuring is one of the bigger ones. Structuring includes the act of parceling out what would otherwise be a large financial transaction into a series of smaller transactions to avoid the scrutiny of regulators and law enforcement. Structuring often appears in federal indictment related to money laundering, fraud, and other criminal activities. And for those of you who remember those 80s cartoons, the term smurfing was coined in the banking industry for this, derived from those little images of blue cartoon characters having a large group broken into smaller entities. This is another big one, which FinCEN targets, and that's money laundering. This is the process in which the source of money is questionably obtained and concealed. Money laundering often occurs in 3 steps. First, the cash is placed into the financial system. Second, involves the layering of complex financial transactions in order to camouflage the source of the illegal funds. And third, entails an acquiring of wealth generated from the transactions of the illicit funds. And some of these steps can be omitted depending on where the funds start from. As an example, in non-cash transactions, a lot of times the funds are already in the financial system, so there would be no need for placement into the financial system. Here's some examples of the type of money laundering. Starting with one we just covered, structuring. The purpose of this is to defeat the suspicion of money laundering and to avoid anti-money laundering reporting requirements. There's bulk cash smuggling, or physically smuggling cash into another jurisdiction where it will be deposited into a financial institution such as an offshore bank with less rigorous money laundering enforcement. Cash-intensive businesses is typically involved in receiving cash. The business's accounts will generally be used to deposit both legitimate and criminally derived cash and claim that it's all legitimate earnings. Trade-based laundering is undervaluing or overvaluing invoice in order to disguise the movement of money. Shell companies and trust, which disguise the true owner of the money. Trust and corporate vehicles, depending on the jurisdiction, do not disclose their true beneficial owner. Here's some more examples of money laundering. There's bank capture. This takes place when somebody buys a controlling interest in a bank to move money through the bank without scrutiny. Casinos are used when an individual will buy chips and play for a while and then cash their chips in, for which they'll be issued a check. The money launderer will then be able to deposit that check into their bank and claim it was gambling winnings. This one kind of hits close to home for us when real estate is purchased with illegal proceeds and sold. The proceeds from the sale appear to outsiders as legitimate income. Alternatively, the price of the property is usually manipulated. The seller will agree to a contract that is that underrepresents the value of the property, and then will receive the criminal proceeds to make up the difference. Black salaries are companies that might have unregistered employees without a written contract who are given cash salaries. They are given basically black cash, and that's used to pay them. And here we have, outside of our offices and our training rooms, in some places pretty far away, but still here, there are real examples of people being caught every single day out there in the industry. And the harder they come down on them, the more we're going to see this. In April 16th of 2012, a loan officer in Florida was found to have conspired with others to create and submit false and fraudulent Federal Housing Administration, or FHA, mortgage loan applications and accompanying documentation to a lender on behalf of unqualified borrowers. The loan officer was sentenced to 54 months in prison, 3 years of supervised release, and was ordered to pay $9.2 million in restitution to HUD for the role in their mortgage fraud scheme. Before that, on March 13th of 2012, a man in Virginia pled guilty to engaging in foreclosure rescue schemes that defrauded homeowners and mortgage lenders. Making promises that people could remain in their home after the sale and pay rent to buy their homes back when they were financially secure, the scheme was completed by the execution of false closing documents showing proceeds going back to the homeowners when they were actually going back to him and other straw borrowers. This scheme, in this scheme in particular, the homeowners were actually evicted shortly after the closing of the loan. He was sentenced to 33 months in prison, followed by 24 months of supervised release, and he will be required to pay $216,000 in restitution to his victims. So as you can see, the government's getting a little more serious about this, and you know, with regulations like FinCEN, they're making it very evident that this is getting more serious. Penalties for noncompliance. Enforcement of the Bank Security Act is done through the Federal Banking Regulatory Regulators' Administrative Powers. In the past, the regulators have brought administrative actions and, in some cases, civil money penalties. Several companies have been charged with failure to file SARs and have been subject to, on the criminal side, to deferred prosecutions and significant penalties, and on the administrative side, to administrative enforcement actions leading to cease and desist actions and more substantial penalties. Unlike most regulations where outside of the participation or the actual participation in the fraudulent activities, the officers within the company were more likely to be subject to criminal prosecution. With the Bank Security Act, the training provided, failure to comply and knowingly failing to file SAR reports can lead to the individual employee's criminal prosecution. It's a very good rule of thumb to always keep in mind that if something is questionable, say something about it. Compliance and quality control have been a factor in the daily operations of most financial institutions for a very long time now. However, with FinCEN's rule, it is a very pointed reminder that compliance is a major responsibility throughout the entire organization and not just the departments that are designated to find it in random selections. From the moment the phone call is made to take an application, the responsibility for identifying illegal, fraudulent, or even suspicious activity will fall into the hands of every single employee to touch or work on that loan. In today's industry, it's going to take united efforts, training, and communication. These are the things that have not only kept the doors open, but the files in our racks and the desks filled with professionals that can assure our customers that we here at Mountain West Financial have the knowledge and the tools and the drive to protect them as well as ourselves from concerns that involve money laundering, terrorism, and fraud. That's going to conclude this training for FinCEN, and here you'll find a link to be able to take the test. I wish you all good luck.